This is Traders Workshop with Adam H. Grimes. Hello, welcome to episode 14 of Traders Workshop. What's luck got to do with it? I'm your host, Adam Grimes. You can find more of my work at adamhgrimes.com, and you should also follow me on Twitter at adamhgrimes. So this is a reissue of an old podcast episode from 2017. I had a previous podcast series, and this episode was done in response to a reader question. I think it drives to some very important points that will help us understand, first of all, why trading is so hard and how we need to shape our work in the market and our psychology to fully embrace the complexities of luck and randomness. With that, here's the old episode. So the topic of today's episode is, what does luck have to do with it? And this was prompted by a question from Jason. Let me read the question and I'll edit the question a little bit as I read. So he says, Mr. Grimes, I need to ask you something. I've been watching your videos and I'm a little confused about one thing. On one of your examples, you showed a diagram of a collection of people making, I believe, 250 trades. He's correct. And there was a winning process supporting those trades. The diagram showed that a certain amount of people still lost money, and you made a comment that winning and losing was random, even with a successful process. This information really made me take a week off to think, do I really want to do this with my life? I know the market is unpredictable, but even with a process, risk management, and slight odds in my favor, I could still lose all my money, even after 5 years of trading small like you recommend. Are you saying that winning and making money is completely random? Thank you. So it's a bit of an emotionally charged question, and I've written about this, talked about this in my book and various blogs and presentations because I think it's such an important point. In fact, in the links to this podcast, I'm going to share some resources and some blog posts I did a couple years ago. But I thought this was an important enough topic that in this light of this question, thank you for the question, Jason, that it was worth resurrecting the topic. So let me kind of bullet point some answers, and then we'll dig into them a little bit deeper. So high level perspective, here are the 5 things I would say. You have to have an edge to trade. Number 2, you must be consistent and trade with discipline. Number 3, avoid mistakes. Number 4, accept that luck matters, but so does skill and edge and process. And number 5, understand that many of your emotional reactions to trading are misplaced. So what we're doing here, what I hope to do in this answer is to move from the objective to the subjective. To move from, first of all, let's talk about what we do in the market and what the objective results are likely to be if we could be perfect. And as we get deeper into the question, let's talk about the things that frankly keep us from being perfect. Let's talk about the emotions and a lot of our very, very human reactions, which it's important to understand those. So first of all, you have to have an edge. I can't emphasize this enough. And if there's one theme from all of my work over the past 10 plus years, I've been blogging and writing and talking about trading, it's really that. You have to have an edge. And if you don't have an edge, none of this other stuff matters. Now, many of you are saying, oh, of course, I'm in this group. Somebody gave me a system. I bought a system. I got this great book. I watched some YouTube videos. I know how to read the tape. I know Fibonacci level. I can go on and on and on. But unless you really have some expectation, some reason to have an expectation that if you make a lot of trades in the market, the pile of your winning money should be bigger than the pile of your losing money, you don't have an edge. And if you don't know what your edge is, you don't have an edge. That comes from Jack Schwager, and I think it's one of the most profound things I've ever read about operating in financial markets. It's not really the topic of this podcast, but I can tell you, most of you listening, unless you've been on this journey for a long time and you've done a lot of work and a lot of research, you probably don't have the edge you think you have. And if you do think you have an edge, then you probably need to do a lot more work to understand that edge. It's an ongoing process, and most traders that fail don't have an edge. In fact, I would say, we know the statistics overwhelmingly show that the vast majority, certainly north of 90% of traders, lose money. And having an edge is one of the things that you can do. That does not guarantee. There's no guarantee. But having an edge is one of the things you can do that greatly increases your chance of being in that elite section of traders who actually pull some money out of the market. So number 2 and 3 are really connected. You must be consistent, you must trade with discipline, and you have to avoid mistakes. Now, one of the dirty secrets about trading, one of the things that, if I look at my personal trading journey, I thought I was going to find this magic pattern that I traded in the market, and the market would be an ATM machine. I just turn on the computer and I would make money in the market. I thought it would work like that. And many of us who start have that very incorrect, we laugh at it as a naive assumption, but we all start there. And those of us who figure it out progress from that point and go somewhere else. But what we realize is that the edge probably does not look like you expect it to look. All there is, the only thing that is possible is a slight edge in the market. If you can imagine flipping a coin that comes up heads just a little bit more often than tails. And most of the statistical edges in the market, depending how we quantify them, but you should be looking for numbers like, let's assume 50% is no edge. Your edge is probably going to be 50.5% or 51%, 52% maybe. There's no 80%. There's no 90%. Now, this is not win ratio because we can massage that with stop sizes, but the objective edges that you find in the market are not going to be huge because huge edges do not exist. It's very hard to make money in the markets. Markets are very competitive. A lot of smart people, a lot of smart money is constantly scouring the market to look for edges. And so, of course, there's no free money lying around. And if you think you found it, you've made a mistake. It's very simple. There's no free money in the market. So if we accept that, then we know all we have is that very, very small edge. So how do we win? Well, we need to apply that edge over and over. We need to somehow avoid getting blown out of the market. We need to avoid the kinds of mistakes or the kinds of events, maybe they're not even all mistakes, but the kinds of events that could completely take us out of the game. And a good example is somebody who just sells a lot of option premium. These types of traders might make money year after year after year after year, and then in a single overnight move, wipe out all of their trading profits from decades. It's very, very possible. And we want to avoid things like that. We want to avoid those types of tail events that can destroy our financial well-being. But we also want to avoid mistakes. What are the emotional mistakes? Well, not following your system. And this can work a lot of ways, right? Maybe you have signals to get into the market and you can't execute those signals. You just can't do it. You can't get in. Maybe you have signals to get out. Your stops are hit or something. You can't get out. Maybe you do get out, but you get right back in. Maybe you get out, but you get right back in bigger because now you're angry and now you're revenge trading. These are these are classic mistakes. Many of you have made them. And if you haven't, trade a little bit longer and you probably make some of these. Other mistakes, fat finger mistakes, misplaced decimal point, extra zero, order on the wrong side of the market. Wrong type of order. You think you're entering a limit order, but you mark it a stop order, so it executes immediately. All of these things are errors and frictions that will take a piece out of your account. And we're human. Even institutions, even large institutions, mistakes still happen. But these mistakes, as an individual trader, we need to work very, very hard to avoid those mistakes, and certainly to insulate ourselves from the kinds of emotional mistakes that I was talking about, because it's very possible that with one of those emotional mistakes, you can easily craft the type of experience that takes you out of the marketplace and transitions you to another career. And I say that kind of jokingly with a smile, but it's a very serious thing. One day of revenge trading, you can wipe out an account. So it doesn't even take a day. So you want to be very, very careful. Now, those are objective things. Let's turn our attention inward. And I want to take this question apart a little bit deeper, because I think I have some idea about a few of the things that might be going on with Jason. I'm going to make some guesses. I'm going to tell you why I'm making those guesses, which I think is going to be more instructive than just my random guesses. But let's turn our attention to the behavioral aspects driven by emotion, by feelings and reactions to the things we think. So one of the first things that I would tell Jason or anybody is that you do have to accept that luck matters. That's the bottom line. That's the kind of the punchline to all of this. Is I wrote a blog, I think in 2014. I'll link in the comments, but the question the blog started with was, what does luck have to do with it? And the answer is, it turns out quite a lot. And that's true. Luck has a lot to do with your trading results, but so does skill. And so does system, so does process, so does having that edge. Now, how does luck matter? Let's look at this example that prompted Jason to ask this question. This is an example that I originally put in my book, and I've ripped it off and used it in many presentations, many places over the years. And what I did was I just created a very simple system that had an edge, and you can use whatever numbers you want. You can make the edge, you'll see, you can easily model this in Excel, and you'll see very different results depending on the size of the edge. But one thing that I would caution you about is be careful if you want to replicate this and play with this, that you don't make the edge too big. What would be an example of too big? Let's say you win 60% of the time and your wins are 3 times as big as your losses. Well, yeah, okay. If you run a system like that, you're going to discover no trader ever loses. But it's also not the reality. It's not even close to what your actual system is going to look like in the market. So work with a very small edge, and that's what I did. I created, I believe it was a 50-50 win-loss ratio, no break-evens, and I think the wins were 1.2 times the size of the losses. And if you want to be more sophisticated, I was just looking for a very basic example. If you want to be more sophisticated, you can do things like change the size of the wins and losses. So you're drawing this from a probability distribution. I was just using fixed numbers. The coin comes up heads 50% of the time, and you win 1 spot 2. It comes up tails. The other 50% of the time, you lose 1. So you can model this and play with this. And then what you do is you set up that system and you run it through a number of trades. How many? Well, this is one of the questions I think a lot of people get wrong. And people say, how many trades do I need for statistical analysis? And the answer is 30. Well, it's not. That's not the answer. No, it's not the answer. But it's the answer that's always given. How many do I need? Oh, 30. Why? Well, there are some statistics 101 reasons that people kind of gravitate to that number. And somebody in a trading book a few years ago used 30 as the answer to that question. So it's the answer everybody throws around. But no, and you'll see when you actually do this, 30 is not at all enough in this case. So I'd encourage you to model 100, 250, 1,000 trades even. And you end up with this timeline, and then you can graph those. So basically what you've done is you can think that you've graphed one trader's theoretical P&L, trading a certain number of the trades. And then the next thing you want to do is do that for another trader and another trader and another trader. So you end up with, if you imagine that the days run vertically, you end up with many columns. So you have each row is a day in a spreadsheet. You also end up with many columns, which are the individual traders. And what you'll find is some remarkable variability. you'll see that very few traders actually make exactly what you would expect. That there are many traders who make a lot more and make a lot worse, or make a lot less, and even some, depending on the edge, lose money. And in this particular example, what I show is that yes, the system has an edge. And keep in mind, nobody made mistakes trading it. Nobody made any of these emotional mistakes and traded too big or revenge traded. Nobody did anything stupid. It was just the way it worked out, purely by luck, that some traders were underwater for many, many trades. And so you had these traders who might have been trading 50 trades even, where with a system that has an edge and they're underwater. They're losing money from the starting point. And I believe in this specific example, but it's just one example, I don't think anybody, maybe one trader actually ended up losing money. Everybody else ended up a little bit, but with a pretty big spread on where they, quote, should have ended up with the expected value of the system. So that is the statistical concept is not that difficult to grasp. However, the impact of the statistical concept and how it feels to live through that is not at all intuitive. And you could very well have somebody who has deep statistical training who is completely unprepared to deal with the reality of seeing their trading account go down when they do everything right. And this does happen. This will happen. But if if you think about the practical implications, if you were underwater 50 trades, you'd take a serious look at the system. And in fact, most traders would have abandoned the system at some point, because I guess it depends on how, 50 trades could be a day if it's a high frequency system, but depending how long it takes to get through that, it might be something you could not trade psychologically or emotionally. You're just going to handle it. This issue of untangling skill and luck. Michael Mauboussin wrote a great book on just that topic, and there's also a 2-hour video where he deals with these issues. He's talking specifically about investments, of course, but he also goes into related fields like sports and other performance fields. And he has some interesting ideas, some challenging ideas. One of the ways, if you aren't sure if your results are due to skill or luck, you can try to lose deliberately. And I've suggested this to many traders over the years. I remember watching a guy who thought he had great skill reading the tape, and he was imagining, I'm still convinced he was imagining all of this stuff on the tape, all of these big orders, and kind of inferring all of the significance from random noise on the tape, and yet not really making money. And I said, well, if you think your system has an edge, why don't you turn it upside down and try to trade against it and see if you lose money? And this trader was trading very small, so the financial impact would not have been significant, but he couldn't do it. Very few people could bring themselves to do that. But if you let's say that you think your system results rely on stop placement around Fibonacci level, for instance. Well, what happens if you move it 10% or something like that? And so now what this actually is, this idea of trying to lose or changing things, this is a kind of statistical test and a very practical, common sense wrapper, but that's worth playing with. And I would definitely point you to some of the resources that I'm going to link to in the notes here. However, without getting too far afield, just coming back to this idea that your trading results are going to have a lot of variability. There is no way around this. That is the reality. The trading methodology that has no drawdown, unless you have access to some type of information or order flow, and so we're talking on an institutional frame, in an institutional framework, but no individual trader has this kind of access or this kind of expertise. So you don't. And I don't mean that you're learning to read market profile or you're learning to read the tape or something like that. That's not what we're talking about. That's not this kind of edge. But outside of having that edge, there is no trading methodology that can skip a drawdown. basically you're going that's what variability and luck is in your results. Is one of the way it looks is drawdowns. And if your idea of trading or creating a trading system is you're somehow going to avoid drawdowns, well, as I said at the beginning, I think we all kind of start there, but that's not reality and it's not possible. And it's not going to be your trading results. I can absolutely guarantee 100% that you are going to have losing periods, you are going to have drawdowns, and that's just the reality. So you can accept it. You've got a choice, right? You can accept it or you can not trade. That's I know a little brutal to say, but if you can't accept, if you can't handle that your results include a big random component, then you can't trade. And that's it. So luck, let me go back to these bullet points, then I'll dig into this question a little bit deeper because I think there may be some instructive points for everybody. So what does luck have to do with it? A lot. Well, how do we understand luck? How do we manage luck? How do we insulate ourselves from the impact of luck? First, you got to have an edge in the market, and I can't emphasize this enough. I feel like almost every talk I give should just be about that. People get very bored very quickly, but so many people are doing things that just don't have an edge. So you really, it can't be overemphasized enough. You have to have an edge in the market. Once you do have that edge, then you must be very consistent and disciplined in how you apply that edge. In particular, you need to avoid mistakes. There's a litany of possible mistakes and things we can do to hurt ourselves. You got to avoid all those. They'll destroy you. Psychologically, you have to accept. You have to have a profound comfort with uncertainty to be a trader. You have to accept, which is another way to say that luck matters. But so does skill, so does system, so does process, so does methodology. And when we really understand that, when we understand everything I've just said and how variable your results can be, we begin to understand that many of the emotions we feel, many of the emotional reactions we feel are not appropriate. And I struggled a lot. I'll tell you, when I wrote the outline for this podcast, what word to use there. Your emotions are wrong. Well, of course not. Your emotions are never wrong, but your emotions can certainly be not constructive. Your emotions can be irrational. In fact, most emotions by definition is another way to experience, right? It's not rational. But in particular, watch yourself for reactions to things that are probably just random fluctuation in the market. And this can come as a period of months where we struggle to find entries, months where we struggle to find losing trades, can come in a long string of losing trades. These are the sorts of things that you will have in your career. Absolutely, I can promise. But if you understand that so much of this is just this kind of magical playground where luck and opportunity and risk and all of the stuff mushes together, and you reach into the grab bag and you pull something out each time, sometimes you're going to get strings of losers, and that's just part, or you're going to have some of these unfortunate things happen, but that's just part of the process. Now, let's dig into Jason's question a little bit more. One of the things that I suspect is, and so he says, where does he say this? Okay, so this sentence in particular caught my attention. Are you saying, quote, I could still lose all my money even after 5 years of trading small like you recommend, end quote. Two things here. Well, first of all, trading small like I recommend. Now, I suspect that Jason is seeing other information online and that advises trading much bigger. And for instance, I just saw in a Facebook group, a Forex guru was looking at risk levels and coming to the conclusion that you probably should risk 10 to 15% of your account on each trade. Now, that's horrifying. Frankly, I don't know. From a professional standpoint, that's absolutely horrifying. And you can see very quickly, well, imagine you have 3 losing trades in a row, and if you're risking 10% of your account, you're down somewhere around 30%, right? That's really rough. And particularly if you have any investors, they're gone. And the feeling of that kind of drawdown, it's very hard to recover from. So one of the things that I suspect is that guru and perhaps Jason's thinking is colored by being undercapitalized. And of course, what you could do, if you want to open a $500 account somewhere and trade it with 20% risk on each trade and treat it as a lottery ticket and have a wild ride, well, of course, who's to say you can't do that? You can do anything you want. But it's not a professional approach to trading. And many of the things that we do in terms of risk management and position sizing are basically designed to keep us from getting destroyed by one losing trade. Because, by the way, that Forex guy trading 10%, risking 10% on each trade, what happens if he has a trade where he loses 2 to 3 times what he thought he was risking? And this happens. Don't tell me that, you're day trading, you're going to manage your risk very carefully. Your electricity never goes out, your internet never goes down. You do this long enough, you're going to have some event where you have an outsized loss. If you're trading at very high risk levels, one outsized loss can be account destroying. And that's unacceptable. So I think he is likely listening to other advice that suggests you should trade much bigger. And much of this is centered around being undercapitalized. And one of the sad realities of the market, we would love to say that you can go into a market with $2,000 and make $1 million. And people have done that. It is theoretically possible. But people have also spent their last dollar on a lottery ticket. It's the same thing. And somebody wins, but that does not mean that this is how you are going to win. That does not mean that this is the path. That does not mean that it's a reproducible path in any way. And the reproducible path is to have an edge and to trade controlled risk, restrained risk on each trade, and let that edge work in your favor. The other thing that's very interesting in this question, and maybe I'm reading a little bit too much emotion into it, I could still lose all my money. Well, no. That's the purpose of correct risk management. And if you go back and look at the example, in fact, the example is in my book, where I then take this example and go through risking different amounts, percentages of accounts or fixed dollar amounts. You can play with it however you want. And what I show is just the impact of what I just said, that as you trade much larger, then your risk of blowing out your account, going bankrupt, becomes significant. But trading small, you're not going to lose all your money. You very well may lose. Look, let me just say that clearly. All of those disclaimers, past performance is no guarantee of future results. That's not just disclaimer language. That is reality. And that's a key mode of thought for traders and anybody involved in the market, is that the future is unknown. We hope the past is some guide to the future, but we just don't know. So yeah, Jason, you may very well lose money. And in fact, while you're learning to trade, because you're going to make some of these mistakes, you're not going to trade with discipline, you're probably not going to have an edge, you're going to be able to apply the edge, you're probably going to lose money while you learn. And that's why I think one of the most important things developing traders can do is keep their risk small. You're going to lose a little rather than a lot. But no, I'm not saying that with responsible risk management, short of some very, very, very unlikely event, it's extremely unlikely that you would lose all of your money with proper risk control. And then, of course, the last part of his question, are you saying that winning and making money is completely random? No, I'm not. And I never said that. I never implied that. And it is completely, on any trade, yes, it's random. Any one trade. You go into the market and you place a, quote, bet on a stock or a currency or a futures contract, and you place that bet against anyone in the world, you pretty much have an even chance of winning or losing money on one trade. But over a set of many trades, then all of these other things become important. And I think this is a good question. It's a question that somebody asking this, I think we ask this at 2 points in our careers. And I think somebody asking at the beginning, you probably don't have an understanding of statistics and chance and probability and how all of this works in context of a trading system. Well, it's good. It's good that you realize this is something that is missing from your understanding, so you now know where to learn and where to develop and where to grow. We also, however, will come back to this question at other points in our careers, in tough losing spots, in spots where it's hard to find winning trades, at points where in which we struggle. We'll come back to think again about the role that luck plays, and that there are various statistical tools that we can dig into this deeper to separate our results from luck, but this is an ongoing and great question. Thank you. I hope you enjoyed that. I'd like to ask you to go check out my website, marketlifetrading.com. And if you could, wherever you found the podcast, please like, subscribe, leave a review. It is much appreciated. Thank you very much.